question real big. Right. Let's see. A company is considering investing in a 2-year project. All right. We are going to make a 2-year investment. Machine setup cost will be 125,000 payable immediately. Immediately means it's payable today itself. Today itself meaning year zero. So year zero, there is going to be a cash outflow of 125,000. Working capital of $4,000 is required at the beginning of the contract and will be released at the end. Okay, so working capital is required at the beginning, meaning once again, year zero, it should be there in place prior to year one. So in year zero, another cash outflow of $4,000. Okay. And then once again in year two, what's going to happen? We are having a cash inflow of 4,000. Why are we having this cash inflow of 4,000 in year two? Why did I put 4,000 over there? Any idea why? What's with that 4,000 over here? Ah, very good. So guys, remember, whenever we make an investment into working capital, so in year zero, today we have invested $4,000. Whatever the amount is put into working capital at the end of the project, at the end of the project, on the final day of the project, we will be able to recover that investment. So in year zero, we have invested 4,000 as working capital. In year two, the final year of the project, we are recovering that investment. Okay. So given the cost of capital of 10%, if your cost of capital is 10%, what is the minimum acceptable contract price to the nearest $1,000 to be received at the end of the contract? Any idea how this question should be approached? How should we do this question? Interesting question. Okay. So when they say minimum acceptable contract price, minimum acceptable contract price, NPV should be how much? How much should the NPV be? Everyone, how much should the NPV be? Should it be $1? Should it be $100? When they say minimum acceptable amount, what is going to be your NPV? Should it be zero? Should it be 100? Should it be 1,000? When they say minimum acceptable amount, NPV should be zero. All right. So let's calculate the present value of these particular cash flows. Okay. So over here, the total cash outflow is 129,000. Okay, so we're going to multiply it by the discounting factor 10%. Multiplied by what? Over here it's nothing. 0, 0.926, 0. Uh, 0.909, 0.826, right? What is the present value? 129,000. 4,000 into 0.826. 3,300 what is the present value? 125,696. These are what? Negative figure. It's a cash outflow. Okay. So the present value of our cash outflows of the cash outflow is what? 125,696. Okay. So in order for us to get an NPV of zero, in order for us to get an NPV of zero, how much should the present value of the cash inflow be? It should be the same as this. If the present value of the cash inflow is equal to the present value of the cash outflow, then the NP will be zero. So according to that, okay, we know the present value of the cash inflow should be $125,696. Okay. So now this cash inflow should be received when we are going to receive this cash inflow in year two. Okay. But they did not ask in this question, they are asking what is the present value of the cash inflow. What are they asking? What is the minimum acceptable price to be received at the end of the contract? So they are asking how much should we get in year two? How much should we receive in year two for the present value to be 125,696. Okay. So what they are asking us is not the present value. What they need is the future value. Okay. So we know, okay, the cash flow into the discounting factor is giving us the present value. So we need this cash flow, we need this future value. Therefore, what we do? Present value divided by the discounting factor will give you the future value. We can say that what cash flow. Okay. So here the present value is 125,696. So we're going to divide that by 0.826. What is going to be the cash flow? What is the contract price? 152,174 dollars. That is yours. Okay, so it's not a difficult question. Just that you have to understand what they are asking. Okay, is this clear? I hope it is. Moving on. Which two of the following statements are correct? Statement A. Tax allowable depreciation is a relevant cash flow when evaluating borrowing to buy compared to leasing as a financing choice. So they are saying basically in a lease or buy decision, okay, tax allowable depreciation is a relevant cash flow, true or false. If it's true, send a D. If it's false, send a F. Okay, so if it's difficult to type, certain times I know, no, it might be difficult to type. TRUE, very difficult, understandable. You just send a D. Okay. At least do that, please. True or false? Online, make it fast. Don't waste time. Statement A or false. False. Correct. Statement is false. Okay. Why is it false? Again, read very carefully. Guys, depreciation, tax allowable depreciation in itself is not a relevant cash flow. But the tax saving which you're getting on this tax allowable depreciation is the relevant cash. Depreciation is not relevant. Tax saving is relevant. Just because you see the word tax allowable doesn't make the depreciation a relevant cash flow, all right? The tax saving which we are getting is the relevant cash flow. Okay. Next, asset replacement decisions require relevant cash flows to be discounted by the after-tax cost of debt. Yes or no? False. Okay. So then for asset replacement decisions, what discount rate should be used? What should it be discounted by? Asset replacement decisions. So you're saying it's not the after-tax cost of debt, then what should we use? Should we use the after-tax cost of equity? Should we use the cost of preference shares? What is going to be used to discount asset replacement decision cash flows? It is the what? We are supposed to use the cost of capital. Okay. So the after-tax cost of debt is used to discount the cash flows which are related to the lease versus buy. So when you are doing the lease versus buy questions, you are supposed to take the after-tax cost of debt. See, if capital is rationed meaning there is a shortage of capital, not enough of capital to invest in all of the projects. Feasible investment projects can be ranked by the profitability index when determining the optimum investment schedule. Yes or no? That is no problems over there. The government restrictions on bank lending are associated with hard capital rationing. Once again, that's true. So remember, guys, there are two types of capital rationing situations. One is hard capital rationing, the other being soft capital rationing. So hard capital rationing is when due to external factors, if our capital is limited. Soft capital rationing meaning that due to internal factors inside the organization itself, we are having limited amount of capital. So here the answer would be C and D. Okay, pretty straightforward. Question 95. A company has 31st December as its accounting year end. On 1st of January 2005, a new machine costing $2 million is purchased. The company expects to sell the machine on 31st December 2006, okay, 2 years later, for $350,000. The rate of corporation tax for the company is 30%, and tax is paid at the end of the year in which it is incurred. So tax is paid in the same year itself. Tax allowable depreciation is obtained at 25% on the reducing balance basis, and a balancing allowance is available on the disposal of the asset. The company makes sufficient profits to obtain relief for tax allowable depreciation as soon as they arise. If the company's cost of capital is 15% per year, what is the present value of the tax saving on the tax allowable depreciation at 1st January 2005 to the nearest $1,000? All right. Fine. So the cost of the investment is $2 million. So here what depreciation? It is depreciated at a rate of 25%. So what is the depreciation? Here what? 500,000. I don't think there is a need for a calculator over there. Carrying value would be 1,500,000. Year two, will we have a depreciation in year two? Yes or no? Year two, will we have a depreciation? No. Why not? Because year two is the year of disposal. In the year of disposal, we will never have a depreciation, but we have a balancing allowance or a balancing charge. Over here, I guess it's a balancing allowance. Okay. So the scrap value is 350,000. So it's sold at a loss. So what is the balancing figure over here? 1,150,000. Correct. Okay. Thanks. 1,150,000. So we have the depreciation. What do we need? We need the tax saving. So tax saving is what? Depreciation multiplied by the tax rate. Okay, so here it should be 150,000. Over here, how much is it? 345,000. So they did not ask us the tax saving. They need the present value of this tax saving. So we're going to multiply by the discounting factor for 15%. So 15% discounting factor, that should be 0.870. Year one, year two, 0.756. What are your present values? 130,500, 260,800. Net amount, 391,230. That's the answer is there. Looking for. So 391,000 basically. Answer is A. Once again, pretty straightforward question. It's not that difficult. You just have to know the concepts. So guys, if there's a doubt which you're having, if I'm going too fast, if you don't understand something, feel free to just drop a question. I will get back to you. Question 96. An investment project has cost $12,000 payable at the start of the first year of operation. Okay, so that's the investment. The possible cash flows arising from the investment project have the following present values and associated probabilities. So directly they have given the present value. Okay, and the probability. So this is a scenario where there is risk and uncertainty. So here in year one, cash flow can be 16,000, it can be 12,000, it can be 4,000, and the probabilities are also given. So they asking us to calculate the expected value, which is very simple. Expected value is simply cash flow multiplied by the probability. That's it. Okay. So what is the expected present value? Expected present value. You know what? 16,000 into 15%, 12,000 into 60%, minus 4,000 into 25. Can I have the figures over there? Expected present value year two. So year two, the cash flow can be 20,000, or it can be minus negative 2,000. Multiply it by the probabilities 75% and 25%. 16,000 into 15% should be 2,200. 7,200 and 1,000 negative. So year one's expected value is 9,400, 8,000. Year two into 75%, 10,000, 12,500. 2,000 into 25%, 400, $500. Correct? Is my maths correct? Or is it wrong? 15,500. So what is the total present value? Total present value is 8,400 plus 14,500. So that should give you uh much 2,400, 3,600. Total present value is 23,100. Are we done? Is this your answer? Correct. No. No, what we see? Okay. So they have asked for the NPV. They didn't ask for the total present value. They asked the NPV. So NPV is what? Total present value minus the investment. So total present value is 23,100. Investment value they have given it as $12,000 over here, right? NPV is $11,100. Again, a very straightforward question. So how can it be 22,900? 8,400 plus 14,500. Okay. User, I don't know what's your name. Okay, is this okay? So 8,400 plus 14,000. So here is not 8,400, it's 8,600. My bad. Okay. User, all okay? Question 97. The company has a money cost of capital of 21%. The general rate of inflation is 8% per year. What is the real cost of capital? So we are supposed to use Fisher's formula. So what is Fisher's formula? 1 plus I. I is the money rate equals 1 plus R, which is the real cost of capital into 1 plus H. So we know what is I. I is what? 21%. We know what is no, we don't know what's R. That's unknown. We know what is the rate of inflation, which is 8% per year. Okay. So 1.21 equals to 1 plus R into 1.08. So we can take this to the other side. 1.21 divided by 1.08 equals to 1 plus R. Okay. Then 1.21 divided by 1.08 minus 1 equals to R. Therefore, R is equals to how much? 12%. That's it. A company is considering a project that has an initial outflow. Okay, initial outflow, that means in year zero, we are having a cash outflow, maybe $100, followed by several years of cash inflows. Year one, year two, year three, we are having cash inflows, $100, $100, and then a cash outflow in the final year. So final year, we are having a cash outflow. What do we call these types of cash flows? These type of cash flows. These kind of cash flows are called what? What do we call this type of cash flows? There is a term which we use. Annuity? No, it's a cash inflow. So initially we are having a what? Cash outflow, followed by both cash inflows and outflows. So these are called what? Very good, Jamil. Non-conventional cash flows. Don't forget this, very important. Non-conventional cash flows. These are non-conventional cash flow situation where you are having a cash outflow And then the following years, it can be both inflow and outflow. They come again. Here one, inflow is also there, outflow is also there. If it's only inflow, year zero, we are having a cash outflow followed by only inflows, only inflows, only inflows. $100, $100, $100. What do you call this? These type of cash flows are called what? Okay, if this is not conventional, if this is not conventional, this is called what? Conventional. Okay. So remember these things. All right. So they're asking for non-conventional cash flows, how many internal rates of returns could be there? How many possible? Will we have one IRR? Will we have two IRRs? Will we have zero IRRs? Will we have no IRR? What will happen? What's the answer? So again, this is something which we discussed in the class. Remember, guys, in a situation where there are non-conventional cash flows, you can have zero IRR. Sometimes you will not have an IRR. You will not have an IRR. Sometimes you will have one IRR. Sometimes you will have two IRRs. So either you can have zero, you can have one, or you can have. So answer is. So this is what is a weakness of the IRR concept. So when there is a situation of non-conventional cash flows, IRR cannot be used. Okay. So there is a weakness of IRR cannot be used in a situation where there is non-conventional cash flows. Why? Because you might get zero, you might get one, you might get two IRRs. Okay. So once again, this is something which we studied in the class. I drew a graph. We discussed a lot of things. Okay. So if you don't remember it, go and watch the recording once again. All right. Moving on. Question 99. A project consists of a series of cash outflows in the first few years, followed by a series of positive cash inflows. The total cash inflows exceed the total cash outflows. The project was originally evaluated assuming a zero rate of inflation. If the project was re-evaluated on the assumption that the cash flows were subject to a positive rate of inflation, what would be the effect on the payback period and the internal rate of return? Indicate by clicking the relevant boxes. Guys, any idea what happened? Okay, so they are saying, okay, initially we assume a set of cash flows. Initially we assumed a set of cash flows. Year 0, year 1, 100, 100. Then year 2, year 3, year 4, what's happening? Followed by a series of cash inflows. For this set of cash flows, what if you include inflation, if you include the effect of inflation, if you include the impact of inflation, what is going to happen? That is what they are asking for the payback period and for the IRR. Okay. So a quick tip for you all, quick thing to remember, when you all get these type of questions, don't try to think about it. Okay, your brain is not going to work. Using your brain, you can't understand this question. Okay. You will have to do the calculation. Okay. So let's quickly open the Excel spreadsheet and try to look at what's going to happen. Okay, so let me share my Excel. Okay. Year zero, year one, year two, year three, year four. So cash outflow, cash inflow, cash inflow, cash inflow. For the set of cash flows, what is the IRR? Equals IRR over the brackets, 0 to F, 18%. What is the payback period? What's the payback period here? Okay, so if we calculate the payback period, year one we have 100, year two now minus 100, therefore cumulative amount is 200. Okay. Then year three we have an inflow, remaining is what? $100. What is the payback period? 3 years. Okay. Now let's assume for the same cash flows, we are including a certain amount of inflation. Okay. Let's assume the inflation rate is 10%. All right. Not a very big amount of inflation, just a 10% inflation rate. So from here on onwards, it's going to be inflated at a rate of 10% into 1.1. So here it's 100 into 1.1 to the power of 100 into 1.1 to the power of 100 into 1.1 to the power of, okay. So that is the inflated cash flows. Now let's calculate the IRR equals IRR over the brackets. Year one, two. Yes, that is your IRR. What's the payback? Okay. So payback period, year one, our cash flow is, sorry, year zero, our investment is 100. Year one cash flow is 121. Okay. How much to recover? $221 to recover. Year two cash flow. Year two cash flow. Sorry, it should be 110. Year two cash flow is 121. How much remaining to recover? How much remaining to recover? 10 divided by 121. 89. Okay. Year three. Year three, what is the cash flow? 133. How much left to recover? 89. So within year three, our payback is occurring. So let's calculate in terms of years, how much is that? So that is remaining cash flow divided by next year's cash flow, which is 133. So within as a decimal place, how much is that? 89 divided by 133. 0.67. So what is the payback? Payback is 2.67 years. Okay. So now tell me what is happening to the IRR and the payback. What is happening to IRR and the what's happening? What's happening to IRR? First look at the IRR and tell me. IRR is increasing. What is happening to the payback period? Payback period is decreasing. That's it. Okay, so like I said, if you're having a problem understanding a certain question, by doing a calculation, by calculating it, you will be able to understand what's going on. Okay, so through the numbers, trying to attempt the question. So the numbers are proof of certain theories. Okay, so that's the learning over there. So payback is decreasing, IRR is increasing. Simple as that. No, there is no such relationship. There is no relationship between payback and IRR. Okay. Don't think of it like that. Question 100. The lower risk of a project can be recognized by increasing which of the following. Okay. If we increase the cost of initial investment, will the risk reduce or will the risk increase? If you increase the investment amount, will the risk reduce or will the risk increase? Yes. Risk will generally increase if the initial investment is higher. B, if you increase the estimate of the future cash inflows, can you identify a lower risk or will the risk of the project reduce? No. No. There is a project, year zero, investment is 1000, year one, 500, year two, 600. Another project, project B, let's say, same investment, 1000, but year one we are getting 750, year two we are getting 950, which is less risky. Project B is generally considered less risky. Okay. If you are having more cash inflows, it's better. Okay, so that is a lower risk. So this is correct. See, by increasing the IRR, can you identify the lower risk of the project? No, IRR is not correlated to the risk. D, by increasing the required rate of return, what is going to happen? If the required rate of return is higher, that means the risk is higher, not lower. So that's not the answer. Answer is ideally question 101. A company has the following pattern of cash flows for a project, year 0 to year 5. Company uses a discount rate of 10%. In which year does the discounted payback occur? Okay. So these are the cash flows. We need the present value. So we're going to multiply it by the discounting factor. So this is 1, 0.909, 0.826, 0.751, 0.683, and then finally 0.621, I think, yeah, 0.621. What are the present values? 40,000 into 0.909, 36,360. 20,000 into 0.826, 16,550. 30,000 into 0.751, 22,530. 5,000 into 0.683, 3,415. 40,000 into 0.621, 24,800. All right. So let's calculate the discounted payback period. So investment is 100,000. Okay. Year one cash flow is 136,360. How much remaining to recover? 74,000, no, 64,360. 63,600. Year two cash flow is 16,520. How much left to recover? 47,120. Year 3 cash flow is 22,530. What's left to recover? 24,590. Year 4, guys, do we have to continue to do this calculation? Do you have to continue to do this calculation? Yes or no? Do you have to complete this calculation? No, you don't have. Why? What is the requirement? They are asking in which year? In which year does the discounted payback occur? We didn't complete the calculation. Tell me in which year is it occurring? The discounted payback. In which year is it occurring? Discounted payback based on the calculation. So, in which year will it occur? So, now if you do the calculation, we'll get 21,000 something. Year 4 is over. So, it has to be recovered in the fifth year. So, obviously, we know that the discounted payback is going to be recovered in the fifth year. So, when you are doing the exam, when you are doing questions in your exam, you don't have to complete the calculation. So, by this point, if you know, okay, definitely that the final cash flow is going to occur in year 5. If the payback period is occurring in year 5, you don't need to calculate it. Just put it as year 5 and move on. You don't waste the time. So, guys, remember, time management is very important in your exam. Always make sure that you're very confident or you're very comfortable with your calculator. That is one thing. You should be able to use your calculator properly. So, when you are doing questions, make sure rather than doing it on Excel or whatever, that you are using your calculator. First things first. Okay. Be very comfortable with your calculator. What are the functions? Calculator has different functions. You should be able to use it. Make sure you're very fast with your calculator. Along with that, make sure that you're not doing unnecessary calculations. Your calculation should be as short as possible to save the time. So there is a time constraint in your exam. So within a certain time frame, you have to complete everything. So don't waste time on doing unnecessary calculations. But since I am teaching you all, let's finish off the calculation. What is the remaining cash flow? So I'm just doing it because I'm teaching. So but y'all during the exam y'all don't have. All right. So what is the remaining cash flow after year 4? 21,001. Cash flow in year 5 is 24,840. Okay. So if we want to calculate accurately how many years more, remaining cash flow divided by next year's cash flow. So how much is that? 0.85. So discounted payback period is 4.85. Yes. Okay. So we know the answer here is discounted payback is occurring in year 5. That's it. Question 102. Sudan, who wishes to undertake a project requiring an investment of 732,000, which will generate equal annual inflows of 146,400 in perpetuity. The first inflow from the investment is 1 year after the initial investment. What is the IRR? Anyone know how to calculate the IRR in this scenario? Anyone has any idea? It's a reversal of the business finance. Okay. It's a reversal of the business finance. Okay, so let's just quickly explain. Okay. So inflow divided by the investment. Okay, correct, but why? Okay, let me explain the why. Okay. So this is a cash flow which is occurring till perpetuity forever. So if there is a perpetuity, how do we calculate the total present value? As you all know, total present value is cash flow of year 1 divided by the rate. Correct? So now 146,400 divided by the rate will give you a particular total present value. Okay, so divided by certain rate will give you the total present value. So what do you mean by IRR? IRR is the internal rate of return. IRR is the internal rate of return, or else we can say IRR is the rate at which the NPV becomes zero. Okay, so we know that our initial investment amount is 732,000 negative. So in order for you to get an NPV of zero, how much should your cash inflow be? How much should the total present value be? How much should this be? How much should it be? Ideally, it has to be the same as the investment. Total present value should be equals to 732,000. So the rate at which, so then what is the learning over here? The rate at which the total present value is becoming 732,000 is your IRR. Because when you are having a total present value of 732,000, your NPV will become zero. So now we need to calculate at which rate will the total present value become 732,000. So what can we do? R is the unknown value. So we can subject R. That is 146,400 divided by 732,000. Okay, so for a perpetuity, how do we calculate the IRR? Basically, IRR equals cash inflow of year one divided by the initial investment. I have explained the logic behind it. Make sure you remember it. 20%. Simple as that. Moving on. Question 103. Which three of the following are advantages of IRR? Just tell me yes or no, true or false. All of you will respond for this. A. Considers the entire life of the project. Advantage or not? Others, make it fast. Very lazy guys when you're. I'm also feeling sleepy because of your respond when true. Very good. True. It's taking the entire life of the project into consideration. B. It is using cash flows and not profits. True or not? Yes. Absolutely true. Advantage. C. It is a measure of absolute return. Yes, no. It's not absolute. Then IRR is what? If it's not absolute, what is it? Very good. IRR is a relative measure, meaning it is a percentage can be compared. It's not a number. D. It is an accurate calculation. Can we tell that about IRR? No, it is not always accurate. If we are using the IRR formula, it will not be accurate. E. It is useful when liquidity is poor. True or false? Then what is the method which you are using when we are having poor liquidity? What is the investment appraisal method? Very good. We are using payback when we are having poor liquidity. F, it considers the time value of money. True or false, advantage or not? Yes. Very good. It's an advantage. So the answer is A, B, F. Once again, a very easy question. Yeah. 104. Jones Limited plans to spend $90,000 on an item of capital equipment on 1st January 2002. The expenditure is eligible for 25% tax allowable depreciation, and Jones pays corporation tax at a rate of 30%. Tax is paid at the end of the accounting period concerned, meaning tax is paid in the same year. The equipment will produce savings of $30,000 per year with expected useful life deemed to be receivable every 31st December. All right. The equipment will be sold for 25,000 scrap value on 31st December 2005. Jones has a 31st December year end and has a 10% post-tax cost of capital. What is the present value at 1st January 2002 of the tax savings that result from the tax allowable, depreciation. Very same question, but the figures are different. So investment amount is what? 90,000. Year one, what is the depreciation? 90,000 into 25%. That should be 22. Carrying value 67,005. Year two depreciation 67,500 into 25%. 16,875. Carrying value 50,625. Year three depreciation 12,656. Carrying value 30,996. Yeah. Do we have a depreciation? No. So guys, remember this project has a this asset has a useful life of 4 years. We are buying in 1st January 2002, dispose it at 31st December 2005. So 2002, 3, 4, 5, 4 years. So year four we will have a what? Balancing allowance. So how much is that? We don't know. What is the value? What is the balancing allowance? 12,959. Correct? So now we need to calculate what is the tax saving. So what is the timing of this tax saving? When are we getting it? So any issues with regards to the timing? Tax is paid in the end of the accounting period. That means tax is paid in the same year. Year one's tax is paid in year one itself. So the timings of the tax saving is also year one. Timing of the tax saving is year two. Timing of the tax saving is year three. Timing of the tax saving is year four. Okay. So what's the tax saving amount? So this multiplied by 30% will give you the tax saving. Can you all tell me what is the tax saving? Depreciation into the tax rate is giving you the tax saving here. 6750, 5063, 3797, 3891, 3891 or 3809. Both of you all recheck and tell which is the correct one. Sami, calculation is correct. 389, 3890 is there. I think it should be 3891. Okay, 3891. All right. So that's the tax saving. But what are they asking? The present value. They're asking the present value. So these are the what? The actual cash flows, the relevant cash flows. We will multiply by the discounting factor to get the present value. So 10%, I have given the discounting factors. You all can calculate and tell me. Six, round it off and tell, no? 636, sorry, 6,136, 4,182, 2,852, 2,650. Total 15,828. That is your answer. 15,828. Again, very straightforward, but a bit time consuming. What to do? Question 105. Four projects PQRS are available to a company that is facing shortage of capital. So they're in a capital rationing situation over the next year, but expects capital to be freely available thereafter. So this is what we call this type of capital rationing. Right now we are having capital. We don't have capital, but later we will have capital. We call this one single period capital ration. If capital is not available for multiple years, it's called multi-period capital ration. So what is the requirements? So they are given certain projects, the investment which is required, and the NPV. In what sequence should the projects be selected if the company wants to maximize net present values? So what is the method which we have to use? We have to use the what? We have to use the profitability index in order to calculate or in order to identify what is the most profitable investment. So P, let's calculate what is the profitability index for P. So NPV divided by the investment, 60 divided by 90. Profitability index is 3. Q, NPV is 40 divided by, guys, we have to take the capital required for the next year. Why? Because only for next year we are having a shortage. We are not taking the total capital amount. So divided by 10. So that is R. 80 divided by 30. I don't know what 80 divided by 30 is. Can someone tell me? Yes. 80 divided by 40, that is 2. This is 2.67. So who is number one? Q. Number 2, R. T. Okay. Number 3, R. Number 4, S. So that is the order. Q, P, R, S. T. That. Very straightforward question once again. Not difficult. So FM is not a difficult exam. It's very easy. Okay, all the questions will be like this. Question 106. So we'll go for a break at 8:30. Okay. Go for a break at 8:30. Now let's do question 106. Few more questions and then we can go for the break. Alicia is contemplating purchasing for 280,000 a machine that she will use to produce 50,000 units of a product per year for the next 5 years. The products will be sold for $10 each and unit variable costs are expected to be $6. Incremental fixed cost would be $70,000 per year for production costs and $25,000 per year for selling and admin costs. Alicia has a required rate of return of 10%. By how much must the estimate of productions and sales volume fall for the projects to be regarded as not worthwhile? What are they asking you to calculate? Indirectly, what are they asking you to calculate? Can someone tell me? not the break even. I'll rephrase the question. They ask if, in order for you to reverse your decision, by how much should the sales volume fall? What are they asking? Calculate. Anyone? Contribution. Not what I'm looking for. No one? What I ask you to calculate? They ask you to calculate the sensitivity. The sensitivity of the sales volume. By how much should the sales volume fall in order for you to reverse your decision, in order for you to reject the project? That's the sensitivity of the sales volume. That is what they're asking you. So they won't directly tell you certain things. They are not going to directly tell you sensitivity. They won't directly tell you IRR. You should be able to read and understand what is required from you. All right. So we are going to calculate the sensitivity of the sales volume. So we need the present values. Year zero. We're having the investment. How much is that? 280,000. Then sales from year one to year five. So each are $10. We are making $50,000 worth of sales. So each year sales are $500,000. Variable cost $6 year one to year five for 50,000 units. That is 300,000. Fixed cost year one to year five. How much is that? Each year it should be 95,000. Let's calculate what is the present value. So here we multiply it by 1. So sales are occurring from year 1 to year 5. Each and every year sales are 500,000. So we can directly multiply this by the annuity factor. What is the 5-year annuity factor for 10%? That should be 3 point, how much? 3.791, if I'm not wrong. 3.791, 3.791. What are the present values? 1,895,500. 1,137,300. 360,145. NPV 678,055. So how is the sensitivity calculated? Sensitivity is, guys, remember the formula. That is the present value of the variable, divided by the NPV. Okay. So are you sure it's 678,000? So this should be negative, okay? So I don't think that's possible. It should be a lower figure of NPV. Chamat, recheck. It is 1,800,000. So there's no chance. Considering selling and admin cost. Yeah, 95. 70,000 plus 25,000. Okay, Adhika. Okay. 118,000 0.55. Okay. So in this scenario, we are trying to calculate the sensitivity of the sales volume. Therefore, what is the variable which you have to take on top? What is the variable which you have to take? The variable which you have to consider. So NPV is 118.055. Guys, remember, when you're calculating the sensitivity of the sales volume, the variable to consider is what? The contribution. Okay. So yeah, so correct. Contribution. So what is the contribution over here? Present value of the contribution. That should be 600,000 something. Maybe I think 600,000. Yeah, how much is the contribution? Sales minus variable cost. 1,895,500 minus 1,137. Contribution please. 758,200. So contribution is 6.42. I don't think it's 6.42. Try again. Check again. 6.25. 6.25%. Oh, sorry, my bad. My bad. No one corrected me, no? Sensitivity is what? NPV divided by the present value of the variable, not present value of the variable divided by NPV. Okay, so I made a small mistake. None of you all corrected me. So what does it show? None of you all actually know the formula. Very bad. NPV is 1.805. Present value of the variable is right. Now tell me what is the sensitivity? 15.57%. What does this mean? If your sales volume changes, not changes, if your sales volume reduces, if your sales volume falls by 15.57%, your NPV will become zero. Your NPV will become zero. Therefore, you might reverse your decision. You will take back your original decision. That is sensitivity. Okay. But have they asked us to calculate this 15.57%? No, they asked us by how many units should the volume fall by. So currently, what is the volume? 50,000. It has to fall by 15.57%. Therefore, how many units does it have to fall by? 50,000 into 15.57%. That should be 5,000, 7,500, 7,600, 7,785 units. So if your sales volume falls by 7,785 units each and every year, that means your entry will become zero and will reverse your decision. So this is your answer. All okay? All good? No next friends? One more question before the break. All good? So if this was implemented for a part C question, if I use contribution margin, what do you mean contribution margin? What is contribution margin? No, that won't give you the answer. So sensitivity is NPV divided by present value of the variable. Only if you do that, you will get the correct answer and you will get the marks. Okay. Everything okay? Can we start? Okay. So I hope all of you all had your dinner, whatever. We might take the class till maybe 9:30, maybe 10. Okay. Let's start with the next question. Correlate. Data of relevance to the evaluation of a particular project are given below. Cost of capital in real terms, real cost of capital, expected general inflation rate, expected increase in the project's annual cash inflow. So this is the what? This is the cash flow which is sorry. This is the inflation which is related to the cash inflows. This is the inflation which is for the cash outflows. Okay. Which of the following sets of adjustments will lead to the correct NPV being calculated? So guys, I have told you all when we have multiple inflation rates. Okay, maybe you salaries a different inflation rate, for variable cost different inflation rates, fixed cost different inflation rates. When we have different rates of inflation, what method should we use to calculate NPV? Should we use the nominal method, money method, or should we use the real method? Which one? When there are multiple rates of inflation, which one? Everyone. Very good. We have to use the money method for the nominal method. You can't use the real, I mean, you can use the real method, but that is not in your syllabus, all right? So we use the money method, the nominal method. So the discount percentage which you are going to use is going to be the nominal discount rate. So nominal discount rate is not given, let us calculate it. 1 plus I equals 1 plus R into 1 plus H. Okay. So 1 plus I unknown, R is what? 10%, which is 8%. So what is I? How much are you getting over here? 1.18%, I think 1.188. I is equals to 1.188 minus 1. I should be equals to 18.8, right? The discount rate is going to be the money rate or the nominal rate, which is 18.88%. Okay. The cash inflow should be inflated at a rate of 6%. Okay, this is correct. Cash outflow should be inflated at a rate of 4%. So what is your answer? Answer is option. Next question. Spotty Limited plans to purchase the machine costing $18,000 to save labor cost through efficiency savings, right? Labor savings would be $9,000 in the first year and would increase in the second year by 10%. The estimated general annual rate of inflation is 8%. The company's real cost of capital is estimated to be 12%. The machine has a 2-year life with an estimated salvage value of $5,000. It should be dollars, not pounds. Receivable at the end of year two. All cash flow occur at the year end. What is the negative NPV? Right. So year zero, year one, year. So year one, we have the investment, which is 18,000. Year one, what is the labor saving? It would be $9,000. Year two, this savings would increase by 10%. So savings would be 9,900. And in year two, we will have a salvage value of $5,000. What are your net cash flows? 18,000, 9,000, and 14,900. All right. So this is the savings. This is the start. What is the NPV? They have given the rate as 10%. So we can calculate the NPV using the discounting factors. Okay. So, by the way, should we use the money method here or should we use the real method? For this question, should we use the real method or the money method? Others, for this particular question, should we use the real method or the money method? Zamil, correct. So in this question, guys, there is actually two inflation rates. Okay, two inflation. One is the general inflation rate. Second one is the one. This 10% is actually the inflation rate. So labor savings in the first year is 9,000. It's increasing by 10%. What is that? That is an inflation rate. And when in inflation is increasing by 10%, why? Due to the inflation which is specific for the labor, labor savings. So here, because there are multiple inflation rates, we have to use the money method. So again, Fisher's formula is coming into play. 1 plus I equals 1 plus R into 1 plus H. So 1 plus R is 10%, H is 8%. Okay. Sorry, it's 12%, R is 12%. So how much is it? 1 plus I is equals to 1.21. Okay, so I is equals to 1.21 minus 1, I is equals to 21%. So do we have discounting factors for 21% in your discounting table? Yeah, no, right? I don't think so. So we can use the what? The normal present value formula. Okay, present value formula is what? Cash flow divided by 1 plus R. Okay, to the power of n. So here, discounting factor is 1, so that is anyway 18,000. For year one's cash flow, that is 9,000 divided by 1 plus R, which is 21% to the power of 1. Year two's cash flow, 14,900 divided by 1 plus 21% to the power of present values. 7,483. 10,177. What is the NPV then? 385. Negative. What's the answer? C. Okay, so nearest $10. So due to rounding off, certain issues will be there. But the closest answer is C, so that's your answer. Correct. A company buys a machine for $10,000 and sells it for $2,000 at time three, year three. Running cost of the machine at time one are 3,000, time two are 5,000, time three are $7,000. If a series of machines are bought, run and sold on an infinite cycle of replacement, what is the equivalent annual cost of the machine if the discount rate is 10%? All right. So let's calculate the EAC. So what is the formula for EAC? EAC is the one NPV divided by the annuity factor. So first we need the NPV. So year 0, year 1, year 2, year 3. So we have the investment, we have the running costs, and we have the scrap value. So investment is $10,000, running cost is 3,000, 5,000, 7,000. Scrap value is 2. 10,000, 3,000, 5,000, 5,000. Discount rate is 10%. What is the discounting factor? 1, 0.909, 0.826, 0.751. Present values, 2727, 130. Three seven double five. NPV. So since all are negative, you can add everything. 12,000, 16,000, 19,000, 20,612. So we know NPV is EAC is NPV divided by the annuity factor. 10% 3 years is 3.791. Is it 3.791? What is the annuity factor for 3 years? That's 5 years is 3.791. For 3 years it is 2.487. What is the EAC? 'Equivalent annual cost is how much? 8,280. That is the EAC. So if you follow this replacement cycle each and every year, you will incur a cost of $8,188. Right. A company has four independent projects available. Okay, so capital needed in PV. If the project has 32,000 to invest today, and each project is infinitely divisible, but none can be delayed, what is the maximum NPV that can be earned? So once again, we are going to use the profitability index method. That is the NPV divided by the investment. So for project one, NPV divided by the investment profitability index is 3. For project two, NPV 25,000 divided by 8,000. How much is that? It should be 3 point something, 3.1, 3.1, I think. So 3.1. NPV 30,000 divided by the investment of 12,000, 2.5. Here, NPV of 36,000 divided by 16,000, 2.2. Figures are correct? Figures are correct? Can someone recheck? Profitability index figures are correct? Yes, okay, fine. So now how much capital do we have? We have 32,000. We have 32,000 money. The DNA 32,000 capital. So in which order should we make the investment? So we are going to initially invest in the project which is having the highest profitability index, which is project 2. Then project 1. Then project 3. Finally project. So now we are going to invest in project 2. Okay, so how much is the required investment? 25,000. Do we have 25,000? Yes. So that entire 25,000 we are going to invest. Okay. So we will get a return of so how much is left over? $7,000 is left over. Okay. So from project one, what is the NPV which we are getting? NPV which we are getting would be how much? 8,000. Remaining we have $7,000 we are going to invest in project one. So project one, the total capital which can be invested is 25,000. I'm sorry, my bad. My bad, I did not notice that. Capital is 8,000. NPV is 25,000, right? Then what's left over is 24,000 to be invested in project one. So project one, capital required is 10,000. What's left over is 40,000. So if you invest 10,000 in project one, we will get an NPV of 30,000. Next, third place is project 3. Project 3 has a capital requirement of 12,000. So we will have 2,000 left over. By investing this 12,000, we can get a return of 30. Next, project 4 needs a capital maximum we can invest 16,000, but we are only having 2,000. So we are going to invest that 2,000. If we invest 2,000, what is the NPV, guys? Remember, for each $1 which we are investing, we are getting a return of 2.2. So if we invest $2,000, we will get a return of 4,200. Okay. What is the total NPV then? Total NPV is 60, 85,000, 89,400. Correct? 4,500. Okay. 89,500. Correct? Answer is option B. Okay. So that is the highest possible NPV which you can earn from these particular projects if we have $32,000 to invest. You can try any other combination. See, you will not get a higher NPV than 89,500. That is the maximum possible, highest possible NPV. Okay. Moving on. So how many questions do we have left? Just 10 more questions. We can quickly do these 10 questions and finish off the class. All right. Question 112. A project has an initial outflow in time zero when an asset is bought, then a series of revenue inflows at the end of each year, and then finally sales proceeds from the sale of the asset. Its NPV is $12,000 when general inflation is zero. If general inflation were to rise to 7% per year and all revenue inflows were subject to this rate of inflation, but the initial expenditure and resale value of the asset were not subject to inflation, what would happen to the NPV? What would happen? Any idea what would happen? Would rise. Well, can you check with Excel spreadsheet? Let me share. Let's So they are saying we have an initial outflow, series of inflows, and then sales proceeds from the asset. Okay, let's forget about the sales proceeds and NPV. Let's just take a random example. Year zero, year one, year two, year three, 3 years. Investment, cash flows, and scrap. Investment is $10,000. Cash flows we are getting 5,000, 5,000, 5,000. And this is going to be $2,000. So net cash flow, here, what is the NPV? Let's assume the rate is 10%. Rate is 10%. Equals NPV over the brackets rate, comma, year 1 to year 3 plus year 0. All right. So NPV is 3,936. Now let's assume, there is an inflation rate. General rate of inflation is 15. General rate of inflation is 15. Oh, we take it as 5%. Now, this 10%, what rate? What is this 10% rate? What is this 10%? This 10% is the real rate. This 10% is the real rate without inflation. 5% is the general rate of inflation. Let's calculate the money rate. Let's calculate the money rate. So if you calculate the money rate, that is 1 plus 10% into 1 plus 5% minus 1, 15.5%. So for the same cash flows, let's calculate once again. If there is an inflation, what will be the NPV? Okay. So inflation is only impacting what? These cash inflows. Okay. So we're going to multiply it by 1.05. Then again 1.05 to the power of 1. So to the power of 2. 1.05 to the power of 3. What's the NPV? Equals NPV. Open the brackets, rate, comma, year 1 to year 3 plus years. Tell me what's happening to the NPV. Increasing or decreasing? What's happening to NPV? NPV is falling. NPV is decreasing. What is the reason for that? It's because now, although we are including inflation, so inside these cash flows, inflation is included. But guys, remember, we are discounting it at the money rate. Inside this money rate, inflation is included. So the impact of inflation inside these will be removed. So 5% will remove the inflation, it will be discounted by the usual 10% rate. But the scrap value, what is happening in the scrap value is that scrap value is not being inflated. Therefore, scrap value is just being discounted at a rate of 15%, which is a higher rate. Here it's being discounted at a rate of 10%. So the present value of the scrap value is going to fall. Okay, that is the reason why NPV is actually reducing. Okay, so that is the technical explanation. If you all understood, it's okay. If you all didn't understand, also it's fine. Okay, moving on to the next one. Back to the whiteboard. Sure. 130. Which two of the following statements about investment appraisal methods of return on capital employed and payback period are true? First one, both methods are affected by the changes in the cost of capital. Payback period and ROCE, will it be impacted by the cost of capital? Are we using the cost of capital to calculate it? False. No, it does not impact it's not affected by the cost of capital. B, the ROCE does not take into account the returns over the entire life of the project. False. ROCE is considering the entire life of the project. We are taking the average profits. To take the average profits, we are taking the total profit of each and every year. That statement is false. C, the payback method is based on the project's cash flows. Yeah, yeah, that's true. No issues there. D, a requirement for an early payback can increase a company's liquidity. Also true. Okay, so if we reduce the payback period, if we reduce the expected payback period, that means company is getting cash quicker. So if we are following a 5-year payback period, if we switch to 3 years, that means the cash which we are getting in 5 years, now we are getting in 3 years. So therefore, we will have more cash, so liquidity will increase. C and D. 114. Select whether it is true or false with regards to simulation. First one, it considers the effect of changing one variable at a time. Simulation, are we only changing one variable at a time? True or false? It's false. So when we are using the method simulation, we can change multiple variables. Using which method are we changing one variable? In sensitivity, we are changing one variable at a time. But simulation, we are changing multiple variables at the same time. Second one, it considers the impact of many variables changing at the same time. That's what I said. That is, it points directly to the correct investment decision. False. Simulation sensitivity does not give you a investment decision. It simply gives you, or it helps you identify what is the critical variables, what are the important variables. If such a situation occurs, okay, if our variable cost increases and the fixed cost falls, what is going to happen? So it helps you, it provides you with information to make the decision, but will not give you the correct decision. It assesses the likelihood. Does it give you the probability of the variable changing? Never. Sensitivity and simulation both will never give you the probabilities. Okay. It's not giving you the probabilities. 115. When considering standard deviation as a statistical measure, which of the following statements is true? A. Standard deviation is the measure of variability of a distribution around its mean. That's the definition. Standard deviation means, okay, how much is it deviating from the mean? Simple as that. B, the tighter the tighter the distribution, the higher the standard deviation would be. It's the opposite. If the distribution is tighter, standard deviation would be lower. Next one. The wider the dispersion, the less riskier the situation. No, if the dispersion is wider, the situation is more risky. Why? Because there is a higher, but there is a wider range of outcomes. Therefore, risk would be higher. The standard deviation is the weighted average of all the possible outcomes. So that is not standard deviation, that is expected value. Expected value is a weighted average. Answer is next 116. In relation to a long-term lease, which of the following statements is not correct? First one, all the risks and rewards of ownership transfer to the lessee. Not all of the risks and rewards. The lessor retains a certain amount of the risk and the reward. Sorry, sorry. All risks and rewards of ownership transfer to the lessee. That is true. Okay. All of the risks and rewards will be transferred to the lessee. So if something happens, or if you are earning money through the leased assets, that money belongs to you. Okay. If you damage the leased asset, you have to what? Incur that damage. Okay. Risks and rewards are with the lessee. B. The assets and lease obligation will be recorded in the statement of financial position. Yes, we are recording the right of use asset and we are recording the lease liability. C. The lease period will cover almost all of the leased assets useful economic life. True. D. The lessor will be responsible for the repair and maintenance, which is wrong. Who is responsible? Lessee is responsible for the repair and maintenance. Answer is D. 117. Which goes latest results are as follows. Operating profits, profit before income tax, and profit for the. In addition, extracts from its latest statement of financial position are as follows. What is each post ROCE? Okay. So in this scenario, ROCE is simply operating profit divided by the capital employed. Okay. It's the operating profit divided by the capital employed. So what is the operating profit? 2,500. Capital employed is equity plus long term liability. 12,500. What is your ROCE then? 20%. If I'm not wrong, 20%. Question 118. A company undertakes a project that involves purchasing machinery at a cost of $65,000. The machinery is used on the project for 4 years, generating operating cash inflows of $20,000 per year. It is sold at the end of the project for $10,000. Taxation is charged at a rate of 30%. Calculate the initial return on capital employed for the project to the nearest whole percentage. Okay. So when they say initial ROCE, what is the formula which we have to use? Average PBIT divided by the initial investment. All right. That is the formula. So what is your PBIT? So we are generating cash inflow. Cash inflow is 20,000. Cash inflow is 20,000. So from the cash inflow, if you want to calculate the profit before interest and tax, what should you do? You have to deduct the depreciation. So how much is the depreciation? Cost is 65,000. Cost is 65,000. Scrap value is 10,000. Useful life is 4 years. So what is the depreciation? 55,000 divided by 4. That is 13,750. Okay, so that will give you $6,250 of PBIT each and every year. So we don't have to calculate what is the PBIT for the 4 years and then divide it by 4. You will get the same answer. Why? Because they are telling you cash inflow is the same each and every year. We are not having different cash inflows. So rather than waste the time, we can directly take the 6,250 and we can divide it by the initial investment of the time. So what is your ROCE in that scenario? Your ROCE will be 9.6%. Okay. So they ask for the nearest whole percentage, that is 10. So again, not a very complicated calculation, very straightforward. Moving on. Question 119. A company is appraising a 3-year project with an initial outlay on 1st of January 2004 of $30,000. The project is expected to give the following cash inflows on 31st December of each year. Year 4, year 5, and year 6. Sorry, 2004, 2005, and 2006. All of the cash flows are being are before taking into account specific rate of inflation of 5% per year. The real cost of capital is 4% and the nominal cost of capital is 14%. Using the nominal approach, what is the NPV of the project? Year 0, year 1, year 2, and year 3. So we don't have to do it like this. 30,000, 10,000, 20,000, and 25,000. So if we need the present value, we can multiply by the discounting factor. So for 14%, what are the discounting factors? So, okay. So here they have told us that the specific rate of inflation is 5%. Okay. So therefore, there is a specific rate and there is a general rate. Therefore, we have to use the nominal approach. We have to use the nominal approach. So if we are using the nominal approach, there is an addition adjustment. What is that? We have to take into account the nominal cash flows or the inflated cash flows. Here they have given the not inflated cash flows. So we are going to inflate these cash flows using the rate of inflation, which is 5% into 1.05 into 1.05 to the power of 1 into 1.05 to the power of 2. So to the power of 2 and here it's to the power of 3. So what are the cash flows after inflation? 10,500, 10,050, 10,500, then 20,000 into 1.05 to the power of 2, and then 25,000 into 1.05 to the power of 22,050, 28,940, 41. So we're going to multiply it by the discounting factor for 14%. So that would be 0.877, 0.769, and 0.675. What are the present values? 9,209, 16,956, 19,535. What is the NPV? NPV is 15,700. All right. Next question 120. In relation to the ROCE investment appraisal method, which of the following statements is correct? A. ROCE leads to better investment decisions since it uses accounting profit rather than estimated cash flows. Or it leads to worse decisions using cash flows is better. B. Investment projects with an ROCE greater than the weighted average cost of capital should be accepted. Wrong. ROCE should be calculated. Sorry, the project's ROCE should be compared to the target ROCE, not the cost of capital. C. Investment projects with an ROCE less than the current ROCE of the organization should be rejected. Again, once again, ROCE should be compared to the what? The target ROCE rather than what? The current ROCE level. The ROC takes into account all of the years of operation. Yes, it takes into account the entire life of the project. Question 1 to 1. Tuco is investigating how often it should replace its company car fleet. It is considering replacing every 2, 3, or 4 years. Cash flow estimates have been compiled, and the following negative NPVs have been obtained based on Tuco's cost of capital, years to replacement, and the NPV. Using the nominal activity tables provided, if Tuco adopts an optimal replacement cycle, what would be the equivalent annual cost? So EAC is what? NPV divided by the annuity factor. So 2 years, 11% annuity factor is 1.713. For 3 years, it's 2.444. For 4 years, it's 3.102. For 5 years, it's 3.696. So what is the EAC? 87,162, 85,574, 82,171, 84,107. So what is the lowest equivalent annual cost? 4 years. Going for a 4-year cycle will give you the lowest EAC. So what they're asking, what is the lowest EAC? That is 82,171. That is your answer. Final question. A machine costing 450,000 has a useful life of 6 years, after which time it has a present value of resale of 25,800. The present value of the total running cost is 82 to 80. The company's cost of capital is 10%. What is the equivalent annual cost of using the machine if it was bought and replaced every 6 years in perpetuity? Okay. So this is a positive cash flow. These are negative cash flow. So let's calculate what is the NPV. NPV is investment, okay, plus scrap value minus the running cost, which is negative. So 450,000 scrap value is, so this is a negative value. Scrap value is positive, which is 25,800. Running cost is negative, which is 82 to 80. So what is the NPV? 506,180. So we are going to divide this by the annuity factor to get the equivalent annual cost. Annuity factor is 4.355. So what is the EAC? 16,199. 116,299. That is your answer. Simple as that. Yeah. With that, section A type questions or OTQs are completed from investment appraisal. What's left is section B type questions and FTQs and CRQs. So how are we feeling? All of them? Good. Did you see both of them? Okay. Yes. Guys, all okay? Can I end the class? Can I have a yes from everyone?